Greetings, tax tippers, and welcome to this week's top 5 tax fixes in just 5 minutes. We're gathered together to talk about how to structure your property business from a tax perspective, because the planning that got you here likely won't get you there. I'm going to tell you how you can pass all your property on to your children IHT free, and even how to deal with gold diggers, just in case your kids marry and then divorce a leech. Okay, here we go. Time to shine some white light on the top 5 ways to own property, tax tippers. New in it this week's number 5 is called Property in My Name is a No-Brainer. Well, if you do own property in your own name, it's likely because you're not using your brain. And here's why. There's Section 24 restrictions on finance costs, particularly for higher rate taxpayers. If you get sued, then all of your properties are at risk. You'll likely have the mother and father of inheritance tax problems when you die, and your tax planning options are, well, let's say, limited. Down at this week's number 4, we have a classic called Makes Me Wonder. Not much better than personal ownership is a limited liability partnership, which does have its own legal identity, so it's better if you're sued, and it's transparent from a tax perspective, meaning that each partner pays tax on their share of profit, but, and it's a big but, it doesn't get around the Section 24 issue. With a company, there's limited liability status, which helps with future litigation. It'll sort the Section 24 problem as there's no restriction on finance cost relief, and it might be easier to arrange funding. But spoiler alert, not all limited companies are created equal. So if you were advised to get an off-the-shelf company with standard memorandum and articles of association, then maybe it's time to stop pecking with the chickens and come soar with the eagles. And here's why, tax tippers. Just inside this week's top 3 is another classic called A New Day Will Dawn. You've got to structure things properly from day one when there's no value and no consequences to moving around the tax planning furniture. You need to start with business continuity and succession. That's who's going to get what when you die. Then create NewCo with 2 classes of shares, A shares, which have voting rights and dividends, and B shares, which are non-voting. The A shares, say 100 £1 shares, belong to you and your spouse if you have one, and they're never going to be worth more than £100, and that's why they're called freezer shares. All future growth and value happens in the B shares, which could be owned by your children, but hang on. A new entry at this week's number 2 is called The Piper Will Lead Us to Reason. Next, loan money to your NewCo for your first or next property deal, and the business pays you back from future profits tax-free when you need or want the money. And give away the B shares to your children, or better still, put them in a discretionary trust and make your kids the beneficiaries. Let's see why that's useful, tax tippers. Staying at number 1 is an all-time classic, Stairway to Heaven. Okay, fast forward. Let's say your property business is worth loads of money and you just died. There's no IHT for your children to pay because you didn't own anything of value. Then, say, your daughter wants to buy a house to live in, so the trustees loan her, say, £1 million to buy the house, but her spouse turns out to be a gold digger, the one that you always feared, and they get divorced. Well, your daughter now lives in a house funded by a loan from a discretionary trust, which is owed £1 million plus interest, and where the loan and everything else is governed by the trustee, which means the rules of the trust, which you created in your lifetime. See where I'm going with this? Then, years later, when daughter dies, there's a debt against her estate, which has to be repaid to the discretionary trust, which reduces her estate for IHT. And the forest will echo with laughter, tax tippers. Unfortunately, there's no time left to tell you about other tax planning options, but be aware, there are plenty of them, particularly for bigger property portfolios. Okay, tax tippers, that's it. And as Page and Plant wrote, if your head's humming and it won't go, in case you don't know, the piper is calling you to join him. Well, that's easy to do, and here's how. You can do nothing and stay in the exact same place and pay a shed load of tax unnecessarily, or you can follow the link above for a free tax planning review by property tax experts who are ex-PwC and ex-HMRC, and will make your tax planning like it was our own. And that was property tax planning and how to pass your property portfolio to your children inheritance tax-free, tax tippers. All right, stay bright. Catch you again for breakfast next Sunday. Ta-ra.